Today we discuss the impossible property equation. Welcome to the Property Imperative Weekly to the 10th of March 2018. Hello again. I'm Martin North, Principal Analyst at Digital Finance Analytics. In this week's review of property and finance news, we start with CoreLogic, who reported that last week the combined capital cities returned a 63.6% final auction clearance rate across just over 3,000 auctions, down from 66.8% the previous week. Last year the clearance rate was much higher at 74.6%. And last week Melbourne returned a final auction clearance rate of 66.5% across 1,524 auctions, down from 70.6% the prior week. And in Sydney, both volumes and clearance rates were also lower, when 1,088 properties went to market and 62.4% cleared, down from 65.1% across 1,259 auctions the prior week. Across the remaining auction market, clearance rates improved in Canberra and Perth, whilst Adelaide, Brisbane and Tasmania's clearance rates fell over the week. And auction activity is expected to be somewhat sedate this week, with a long weekend in Melbourne, Canberra, Adelaide and Tasmania. So just 1,526 homes are scheduled for auction, down 50% on last week's final results. In terms of prices, Sydney, Australia's largest market, is a bellwether. There, CoreLogic's dwelling values fell another 1.3% this week, so values are down 4% over the past 26 weeks. Also, Sydney's annual dwelling value is now down 1.04%, and that's the first annual negative number since August 2012. And within that, the monthly tiered index showed that the top third of properties by value in Sydney have fallen the hardest, down 3.2% over the February quarter, whereas the lowest third of properties have held up relatively well, down 0.9% over the quarter, thanks to a 68% rise in first-time buyers in the state. My theory is that Melbourne is following, but about 9 to 12 months behind. The RBA published a paper on the effects of zoning on housing prices. Based on detailed analysis, they suggest that development restrictions, interaction with increased demand, have contributed materially to the significant rise in housing prices in Australia's largest cities since the late 1990s, pushing prices substantially above the supply costs of their physical inputs. They estimate that zoning restrictions raised detached house prices by 73% of the marginal cost in Sydney, 69% in Melbourne, 42% in Brisbane and 54% in Perth. There is also a large gap opening up between apartment sale prices and construction costs over recent years, especially in Sydney. This suggests that zoning constraints are also important in the market for high-density dwellings. They say that policy changes that make zoning restrictions less binding, whether directly, for example increasing building height limits, or indirectly, for example reducing underlying demand for land in areas where restrictions are binding, such as improving transport infrastructure, for example, would reduce this upward pressure on housing prices. At its February meeting, the RBA board decided to leave the cash rate unchanged at 1.5%, no surprise there. Their statement was quite positive on employment, but not on wages growth. They are expecting inflation to rise a little above 2% in the months ahead. They also said that housing markets in Sydney and Melbourne have slowed, and that in the eastern capital cities a considerable additional supply of apartments is scheduled to come on stream over the next couple of years. The RBA also quietly revised down the housing debt-to-income ratio stats contained in E2 statistical releases and their chart pack. It's dropped by 6% from 199.7 down to 188.4. They attributed the change to revised data from the ABS. But it is still very high. And by the way, Norway, one of the countries mirroring Australian mortgage debt at 223, has just taken steps to tighten mortgage lending further. This includes a limit of 5 times gross annual income and a 5% interest rate buffer. We released our February mortgage stress data, which showed that across Australia, more than 924,500 households are now estimated to be in mortgage stress. That's up 500 from last month. That equates to 29.8% of households. In addition, more than 21,000 of those are in severe stress, up 1,000 from last month. And we estimate that more than 55,000 households risk 30-day default in the next 12 months, up 5,000 from last month. You can watch our separate video on this. Our survey showed significant refinancing is in train to try to reduce monthly payments, and we will publish the results of our financial confidence indices next week. The retail sector is still under pressure, as shown in the ABS trend estimates for Australian retail turnover, which rose just 0.3% in January, following a similar rise in December. Many households just do not have money to spend. Separately, the number of dwellings approved rose 0.1% in January, driven by a lift in approvals for apartments. Dwelling approvals increased in Victoria, Tasmania and Queensland, and also Western Australia, but decreased in the ACT, the Northern Territory, South Australia and significantly New South Wales. The ABS also released the account aggregates to December 2017. Overall, the trend data is still pretty weak. GDP has moved up just a tad, but GDP per capita is growing at just 0.9% per annum and continues to fall. Much of the upside is to do with just population growth. But net per capita disposable income rose 0.4% over the past year. Housing, business investment and trade were all brakes on the economy. Real remuneration is still growing at below inflation, so incomes remain stalled. More than 2 in 3 households have seen no increase. It rose by 0.3% in the December quarter and was up just 1.3% over the year, compared with inflation at 1.9%. And in fact, households continue to raid their savings to support a small increase in consumption, but this is not sustainable. The household savings ratio recovered slightly to 2.7% compared with 2.5% last time in seasonally adjusted terms. Debt remains very high, and these are not indicators of an economy in prime health. Another crack in the property market appeared this week when Deposit Power, which provided interim finance to property buyers, closed its doors, leaving an estimated 10,000 residential, commercial and property investors in the lurch about the fate of nearly 300 million worth of deposits. This is after the collapse of New Zealand's CBL's insurance, which was an insurer and guarantor of deposit bonds. You can watch my separate video on this important and concerning event. The public hearings which the Productivity Commission have been running in relation to the competition in financial services covered a wide range of issues. One which has surfaced is the lender's mortgage insurance sector. With 20% of borrowing households required to take LMI and just 2 external providers, Genworth and QBE LMI, the Commission has explored the dynamics of the industry. They called it an unusual market, where there is little competitive pricing nor competition in its traditional form. So the question is the market for LMI functioning? Could consumers effectively be paying twice? On one hand, potential buyers are required to pay a premium for insurance which protects the bank above a certain loan-to-value hurdle, but not the borrower. That cost is often added to the loan taken, and the prospective borrower has no ability to seek alternatives from a pricing point of view. Banks who use external LMIs appear not to tender competitively. On the other hand, ANZ, for example, has an internal LMI equivalent and said it would be concerned about the concentration risk of placing insurance with just one of the 2 external players, as the bank has more ability to spread the risks. The Commission probed into whether pricing of loans might be better in this case, but the bank said there were many other factors driving pricing. all highly relevant given the recent APRA suggestion that IRB banks might get benefit from lower capital for LMI loans, whereas today there is little capital benefit. This will be an interesting discussion to watch as it develops towards the release of the final report. They had already, by the way, noted that consumers should expect to receive a refund on their LMI premium if they subsequently repay the loan. ASIC told the Productivity Commission that there is now an industry of referrers who are often being paid the same amount as mortgage brokers despite doing less work. They said, in our work on broker commissions, that there is a separate category of people who are paid commissions but who don't arrange the loan, but just refer the borrower to the lender. It seems to be that professionals like lawyers, accountants, financial advisors, etc. are reasonably prominent among people who are acting as referrers, and is strange in that commissions that they are paid for just referring are almost as large as those paid to a mortgage broker for doing all the extra work. So this is more evidence of the complexity of the market and of the multiple parties clipping the ticket. The role of mortgage brokers remains in the spotlight, with both the Productivity Commission sessions this week and the Royal Commission next week focusing in on this area. In draft recommendation 8.1 of its report, the Productivity Commission called for ASIC to impose a clear legal duty on lender-owned aggregators, which should also apply to mortgage brokers working under them. ANZ CEO Shane Elliott said applying best interest obligations to brokers could help preserve the integrity of the third-party channel, and that despite the absence of a legal duty of care, consumers may be under the impression that such obligations already exist. He also said there was merit in considering a fixed fee model as opposed to a volume-based compensation, which is paid to brokers currently. The ANZ chief said that there is an absolute merit in exploring such a model, and he pointed to the use of a fixed fee structure in Europe. Industry insiders, on the other hand, argue that a push to switch from mortgage broker commission payments, which normally includes an upfront fee and a trailing payment for the life of the loan, paid by the lender to the broker, to a fixed fee for advice would be anti-competitive. The discussion of trailing commissions also centred on whether there was downstream value being added to mortgage broker clients, for example, annual financial reviews, or being the first point of call when the borrower has a mortgage-related question. The interesting question is how many broker transactions truly include these downstream services, or is it really just writing a loan and then setting and forgetting, whilst the commissions keep flowing? There is very little data on this, but in the UK, mortgage brokers work within a range of payment models, and many mortgage brokers are paid a commission by lenders of around 0.38% of the total transaction. That's about half of the Australian numbers, and some mortgage brokers also charge a fee to their customers. Still on mortgage brokers, they say they expect to write more non-conforming loans over the next 12 months, according to a NonBank Pepper Money survey. They commissioned a survey of 948 mortgage brokers, which showed that 70% expect to write more non-conforming loans in the coming year, while 66% predict a decline in the number of prime loans written. Surveyed respondents expect the demand for non-conforming loans to rise as a result of tighter prime lending criteria at 22%, changing customer needs 21%, and changing legislation or regulation 13%. The survey also found that the number of brokers who haven't written a non-conforming loan so far has also reduced, falling by 6% from 18% in 2016 to just 12% in 2018. Another non-bank, Bluestone Mortgages, cut its interest rates by 75 to 105 basis points across its Crystal Blue products. These products include a range of full and alternative documentation products, which provide lending solutions for established self-employed borrowers with greater than 24 months trading history, and also pay-as-you-go borrowers with a clear credit history. The lender expects the rate reduction coupled with the 85% low doc option to drive the uptake of the portfolio. The rate cuts come shortly after the company was acquired by the private equity firm Cerberus Capital Management. Parent company Bluestone Group UK is fully divesting its interest in Bluestone Mortgages Asia Pacific as part of the acquisition deal. The ABS released their latest data on assets and liability of Australian securitisers. At the 31st of December 2017, total assets of Australian securitisers was $132.5 billion, up $7.3 billion or 5.9% compared with September. During the December quarter, the rise in total assets was primarily due to an increase in residential mortgages, up $6 billion or 6%, and also by a small increase in other loan assets, up $0.9 billion or 6.1%. You can see the annual growth rate accelerating towards 13%. This is explained by a rise in securitisation from both the non-bank sector, which is going gangbusters at the moment, and also some mainstream lenders returning to the securitised funding channels as costs have fallen. There is also a shift towards longer-term funding and a growth in securitised assets held by Australian investors. At December 2017, asset-backed securities issued in Australia as a proportion of total liabilities increased to 89.8%. The non-banks are loosely being supervised by APRA under their new powers, but are much freer to lend compared with ADIs. A significant proportion of business will be investment loans. It's not just the non-banks cutting mortgage rates, by the way, to attract new business. This is the story so far. Banks were lending up to 40% plus of mortgages with interest-only loans, some even more. The regulator eventually put a 30% cap on these loans, and the volume has fallen well below the limit. Some banks almost stopped writing interest-only loans altogether. They also repriced their interest-only loan book by up to 100 basis points, so creating a windfall profit. This is in fact subject to an ACCC investigation to report soon. The RBA and APRA both warn of the higher risks on interest-only loans, especially on investment properties in a downturn. And now APRA has confirmed the temporary 30% cap will stay for now, although the 10% growth cap in investment loans is now redundant thanks to better underwriting standards. So banks have now started to ramp up their selling of new interest-only loans to customers who fit within current underwriting standards, and they are offering significant discounts. Borrowers will be encouraged to churn for this lower rate. For example, CBA cut fixed interest rates for property investors across 1, 2, 3 and 4 year terms. The cuts, which range from 5 basis points to 50 basis points, apply to both interest-only investor loans and principal and interest investor loans. CBA is also cutting some of its fixed rates for owner-occupied borrowers, including a reduction on owner-occupied principal and interest fixed rate loans by 10 basis points over terms of 1 to 2 years, landing at 3.89% for borrowers on package deals. Key rival Westpac also unveiled a suite of fixed rate changes, including some cuts to fixed rate interest-only mortgages, another area where banks have been forced to apply the brakes. They also hiked rates across various fixed terms for owner-occupiers. So the chase is on for investor loans now, with a focus on acquiring good credit customers from other banks. Other smaller lenders, such as ING, Mortgage House and Virgin Money, have also dropped some interest-only rates. Finally, the Grattan Institute released some important research on migration and housing affordability, saying Australia's migration policy is its de facto population policy. The population, they say, is growing by about 350,000 a year. More than half of this is due to immigration. The pickup in immigration coincides with Australia's most recent housing price boom. Sydney and Melbourne are taking more migrants than ever. Australian house prices have increased 50% in the past 5 years and by 70% in Sydney. Housing demand from immigration shouldn't, they say, lead to higher prices if enough dwellings are built quickly enough and at low enough cost. In post-war Australia, record rates of home building matched rapid population growth. House prices therefore barely moved. But over the last decade, home building did not keep pace with increases in demand and prices rose. Through the 1990s, Australian cities built around 800 new homes for every 1,000 extra people. They built half as many over the past 8 years. So there is no point in denying that housing affordability is worse because of a combination of rapid immigration and poor planning policy. But rather than tackling these issues, much of the debate has focused on policies that are unlikely to make a real difference. And they conclude, unless governments own up to the real problems and start explaining the policy changes that will make a real difference, Australia's housing affordability woes are likely to get worse. So the complex equation of supply and demand, loan availability and home prices will remain unsolved until the focus moves from tactical near-term issues to strategy. And meantime, my expectation is that prices will continue south for some time yet, despite all the industry hype. If you found this useful, please do like the post and add a comment or question. I read them all. If you've already subscribed, thank you. I'm really grateful for your support. And if you are yet to subscribe, please do so to receive future alerts. I'm Martin North, Principal at Digital Finance Analytics. Many thanks for taking the time to watch.